What would you do if your investment portfolio like this? A lot of stocks that you own are in red. If this is my personal portfolio, first I'll cry, then I'll laugh at myself, but at the end of the day, I have to fix it. Thankfully, this is not my personal portfolio, but it was a portfolio that was given to me to co-manage together with my investing partner, Victor, who is also the co-founder of the Fifth Person, right? So at that time, Victor and I, when we were given this portfolio, it was around 7-figure in size, and the portfolio was bleeding about close to $400,000 in unrealized losses. I've never shared these stories before, but I thought I could do one session with you here, because if you are in the similar situations, you need to know what to do with the portfolio and turn it from a loss-making portfolio into a profitable portfolio down the road. In this video, I'm going to share with you my experience of managing this portfolio and what are the lessons that you can learn and apply for yourself. My name is Rusmin and I'm the co-founder of the Fifth Person. At Fifth Person, we want to help you to become a better investor through stock selections or portfolio management. Alright, so in this video, I'm going to share with you on how to manage your portfolio so that you can build your wealth steadily and sustainably over the long run. Alright, let's take a look at the portfolio and see what we can do about it. So the very first thing that Victor and I did was to sit down and review the whole portfolio together, and we want to review every single stocks in this portfolio to make sure that these are good quality stock. Victor and I believe that when we buy into the stock, we are buying into a piece of business. So we want to own a portfolio of quality businesses, and when we look at the portfolio, we want to make sure that every single stock in this portfolio has to be a good quality business. And it may seem easy to just say sell this and buy this, but the underlying process when it comes to studying the stock, it takes time. Each company can take up days or even weeks to study them before we confirm whether it is a good business to invest in. So this is not the overnight process that you can just do and then forget about it. There's also a psychological aspects that you need to deal with, because when it comes to portfolio review, you need to make a very hard decision to sell away some of the loss-making company in your portfolio, and this can be a very painful for people like you and I, because it is our hard-earned money and it's not easy to make that kind of decision. So if you're in this kind of situations, you need to make one-time hard decision to let go of some of the companies that are poorly performing in your portfolio. We didn't have this dilemma at that point of time because it wasn't our money, but we still have the responsibility to make sure that the funds perform. So we went in and we reviewed every single stocks in the portfolio. When it comes to reviewing the portfolio, you want to make sure that the portfolio is well diversified across different number of stocks and across different geography. The question is, how many stocks should you own in the portfolio? The answer would depend on your own risk appetite. If you are someone who is very conservative, obviously you want to be as diversified as possible. You want to diversify your portfolio across different industry, across different countries, and the number of stocks could be possibly ranges from 20 stocks to 30 stocks. If you are someone who don't mind taking on slightly more risk, obviously the number of stocks that you have in the portfolio will be slightly smaller, because concentration allows you to make more money if you make the right call. So the number of stocks will be ranges from between 8 stocks to 15 stocks would be a good numbers to begin with. You can always tweak it later part as you realize that your risk appetite could be higher or even lower. It's only when you put the real money, that is the time when you know what is your actual risk. And how do you tell that if you are taking too much risk? The answer is simple, right? If you can't sleep at night and you think about your portfolio or investing too much in one particular stock, it means that you are taking too much risk or putting too much money in that particular investment. So when we were looking at the portfolio that we were tasked to manage at that point of time, there were about 14 holdings in this portfolio with a market exposure mainly in Singapore, Malaysia, and Hong Kong. It was a Singapore-centric portfolio, but the principle that you can learn from this video can be applied across other markets like US or even Hong Kong. So let's come back to this portfolio and see which are the stocks that we can sell at a point in time. Obviously, on the benefit of the high side, if you look at this portfolio, you know which stocks to buy and which stocks to sell. But at the point of time, we don't have the benefit of the hindsight. It's almost like today, you look at the portfolio, you have to figure out what are the stocks that are going to perform in the next 5 years to 10 years. It's not easy to answer these questions, and this was the similar situation that we were facing back then. But definitely there is a way to do it, and Victor and I have the process to find good quality businesses. So we went in and we start to review those stocks in the portfolio, and we start to sell away companies that are not performing, that have poor fundamentals, and then we just sell them. So let me repeat. First, you need to review every single stocks in the portfolio, and second, you need to restructure them. So when I say restructure them, what I mean is basically you need to keep the winners and sell the losers. Okay, so losers are not stocks that are losing money, but stocks with poor fundamentals. They are in a very competitive industry with no economic mode, or in the industry that they are in has been disrupted altogether. So losers are not those companies that have come down in prices after you buy them, but they have poor fundamentals, right? So you need to get this clear, because a lot of time people always think that if you buy a stock, the prices come down, they are considered a bad stock. But this is not how you judge them. You should judge them based on the business that they are in. If they have a lousy business, right, you want to sell them regardless whether the price goes up or down. And I know that psychologically it's a lot easier to sell away those companies that you have bought and the price has gone up and you lock up the profit. It feels better because you make so much money from that. And a lot of times when it comes to companies that come down in prices after you buy them, people tend to ignore them. And a lot of times people hope that the companies will recover in prices. But when it comes to managing a portfolio, this is not how things should work. In fact, you should be selling your losers and keep your winners, because winners are the one that's going to compound your money over the long run, not the losers. Let me show you what we did at the point of time. The first one on the list is this company called Bzos. So Bzos is in the business of multi-level marketing business, or in short, we call it MLM. So I personally don't really like MLM business because this is a business that can scale easily, but the products has to be sustainable. So when I was looking at Bzos, a range of products from skincare to other M&M products in the portfolio, I didn't find any real differentiation between their product versus the competitor. So I wasn't convinced with the business that they have. And with any MLM business, they always rely on the network that they have. The more members that they have in the network, the more sales they can get. So when I questioned the management about their active members in the total memberships that they have been reporting on a year-to-year increment, I was surprised by the ratio of the active members versus the non-active members. After we heard the answer from the management, we decided to let go Bzos. We cut the losses, we took a one-time off painful experience that we have in this stock, and we decided to redeploy the money elsewhere. The second one on the list is this company called Biostate Singapore. Biostate Singapore is in the business of providing engineering services across different industries like oil and gas, wastewater management, and real estate solution. But one division that we like the most about Biostate is this division called Geospatial. So Geospatial is a technology that is very powerful that allows government to do mapping of the country, and they can use the information to help them with the flooding solution, to help them with building the infrastructure, and Singapore government agencies like PUB actually use them. It is a very powerful software and it's very sticky for the government to continue to use them because they have to rely on the engineering solution that is provided by this software to solve real issues on the ground. So this is a very profitable business, and we like Biostate and we decided to keep this company because at that point in time they were still trading at a very good valuation and they were giving us a very good yield, and we decided to keep them. So we don't sell them because the prices of the stock come down after we buy them, but we decided to keep them because the fundamental of the business is still intact and they have a very good management running the business. And similarly, we keep the other two investments in the portfolio, and they were BreadTalk and Food Empire. We found out that Food Empire and BreadTalk fundamentals still remain intact and their growth is still solid, so we decided to keep the investment. In fact, during the late 2011, during the first wave of Euro debt crisis, we added on more position into BreadTalk when the prices was trading at a very good valuation. And for the rest of holdings in the company, we decided to let them go. We decided to take a one-time hit and we cut the losses for very few good reasons. One of them is that some of the companies that the business that they're running, we saw that they were heading nowhere, right? So one example is a company called Epicentre. Sorry, it's pronounced as Epicentre, but this is a company that distributes Apple products in Singapore, and they are not the only distributor here in Singapore. There are other players that distribute the same Apple products in Singapore. I like apples. I personally love Apple. I use Apple products, but as a distributor, there is no real differentiations. And back then, the reason why I invested in Epicentre was mainly because of the growth story that the management spin out at the point of time that they are growing very fast in China. But it wasn't a very good thesis, and Victor and I decided to let go of this company. And the other reasons Of course, we also noticed that some of the management that are running these companies were not very aligned with shareholders, and minority shareholders might be taken advantage of, and we decided to let go of this position, cut the losses, and take the money and redeploy into a better companies. Some of the companies that we redeployed the capital into were companies like Armstrong, Hartalega. This is a listed company in Malaysia that produce 9-track gloves, and we also invested into Supergroup that sell 3-in-1 instant coffee that distribute the product across the Southeast Asia market. We also invested in real estate investment trusts like CapitaLand Commercial Trust and Lipomo Indonesia Retail Trust. We also invest in the REITs manager like ARA Asset Management. We also invested into companies like Centurions and LMA International. And I'll be lying to you if we didn't make any mistake. In fact, we did. We invested in some of these few companies and we decided to sell them because we were wrong with our assessment, and we learned a fair bit of lessons from these companies. But this will be a separate video lessons altogether, and if you're interested, you can check out the link over here where I talk about 6 investment mistakes that you want to avoid. When it comes to portfolio management, it's not possible to get all the stock picking selections out of 10 that you pick, all of them will be right. Definitely there will be 2 or 3 that will go sour, and when you lose money in this company, it is alright because majority of the stock that you have in the portfolio, as long as you get 60% accuracy hit rate, you should be able to perform well over the long run. I want to say this again. I know psychologically it's not easy to cut your losses, but just think about it. If we were to keep the same initial portfolio and we keep it until today, our portfolio result could have been very different. Let's take a look what would happen. If you look at companies like Hyflux, I think we all know today that Hyflux has already filed for bankruptcies and they're looking for a white knight to come and save them. And a lot of Hyflux perpetual securities could not get back the money that they lent out to the company. And companies like Epicentre is almost gone because the company is still traded today, but it becomes a shell company that's trying to sell it to another company. Next is Bzos. This company is being suspended and now is being investigated for fraud. And companies like Courage Marine and First Ship Leasing Trust are living on the life support. And the last but not least, Raffles Education and Matex are trading like a penny stock. So if we were to keep the investment until today, a lot of stocks that we own would have been down by almost 50% to as much as 90%. So looking back, I'm really happy that we sold most of them and we actually take the money and invest into a better company. You see, when you lose money in one stock, you don't have to make back the money the same way that you lost it. You can in fact take the money and put it into a better companies, and the better companies can make back the money that you have lost it. But if you were to keep your money in the loss-making business, you are compounding your losses. So it is not easy to cut losses, but if you think it long term, you want to do it early as possible because the amount will just grow smaller over time. Alright, we are done and I hope you enjoyed this video, and if you do give me a thumbs up. I would really appreciate for that, and if you have any comments, feel free to leave it down below, and don't forget to subscribe to this channel if you want to watch more videos like this, and I'll see you in the next video. Take care and stay safe.